Hello, everybody. Welcome to Managerial Accounting. This is Cost, Volume, Profit. This is part one, an overview. So in Cost, Volume, Profit, we're now in Managerial Accounting. We need to be creating reports to help assist management with running their business operations. What's really important about Managerial Accounting is that for the most part, a lot of what we're studying is to help us make better business decisions. We're not going to be sharing these reports externally. And as we're looking at this area, one of the more important questions that a business needs to know is how do we break even? Meaning that at what point in time are we going to be able to cover our fixed costs, or how much needs to be earned in order to achieve a certain after-tax profit? So in order to do this, to kind of better help us determine what break even is, we're going to do a variable costing income statement. And this is part of cost, volume, profit. And let's take a look at this. What is breaking even? It basically means that we have a zero net income. And in order to break even, we have to go through and cover our fixed costs. Fixed costs, by definition, do not change. It's the rent, machinery depreciation. We might have certain salaries that we have to go through and pay that will not change no matter what happens with the sales volume. And so therefore, if we're looking at a variable costing income statement, this can help us better understand what it's going to take to break even. Think about it in terms of variable costs. What are those? There's going to be those that vary as we produce more. If we're making 5 vehicles versus 5,000 vehicles, that additional amount of direct labor is going to be needed to make the 5,000. So that direct labor is going to be a variable cost. Now, what I'm not going to be covering in the sequence are the different ways to identify mixed costs. And sometimes I'll go through and refer to that as the high-low method, where you might choose to be using regression analysis and also the margin of safety. However, the one thing I will share with you is you absolutely need to take Microsoft Excel or spreadsheet courses. It doesn't matter if you're going to be in accounting, if you're going to be in business, you have to take these classes. Either take them or learn them on your own on YouTube. So what does a variable costing income statement look like? Well, we start with our sales, right? Then we have like less our variable costs. This is going to give us a contribution margin, less our fixed costs, and this is going to give us net income under variable costing. Now, this is what's really important when you are going through and doing these problems. You want to make sure that you're setting them up this way, because I'm going to give you a lot of different formulas that you can go through and use. But at the end of the day, it's all about this matrix, right? It's the first one, the good one that came out with Keanu. I think it was in 99. That's the best matrix. But right over here, that being said, so when we are showing a variable costing income statement, we're going to have our sales. Our sales are going to be the number of units times the sales price per unit is going to give us our total sales. Now, this is what is so important. If we sold X or Y number of units, we have to have variable costs for Y number of units. And we're going to take that, multiply it by our variable cost per unit. That's going to give us our total variable costs. Now, once we basically have our sales minus our variable costs, this is going to give us the contribution margin, or the amount that's there really to go through and to cover what our fixed costs are. Okay, so, but again, this relationship is absolutely critical. The contribution margin per unit is going to be the number of units times the contribution margin per unit. You will go through and see in our examples that I might only be given the contribution margin per unit, or the sales price per unit, or the variable cost per unit. And I'll just be given fixed costs. I'm going to have to find a way to go back in, basically go back into those numbers. So again, I cannot overstate the importance of this particular variable costing income statement. So here are some ratios. If you're taking my class, I will give these to you on the exam, but I want to caution all of you who are going to be learning these different ratios. And the thing I'm going to caution you about is you can go through and say, oh, the break-even point in sales dollars are the fixed costs divided by the contribution margin ratio. Or if you say, well, the break-even in units, I just take the fixed cost divided by the contribution margin per unit. And what are each of those? Well, the contribution margin per unit is the sales price per unit minus the variable cost per unit is my contribution margin per unit. The contribution margin ratio is going to be the sales minus the variable costs in dollars divided by the total amount of sales. So, but I will share with you, once you use a formula to come up with the break-even points in units or in dollar sales, plug it in and make sure that the number works. And what I mean by plugging in is create a variable costing income statement to make sure that what you just did works. Because if you do it right, you should get a break-even point. If I plug in the amount of units for break-even, I should end up with a net income of 0, because that's by definition what break-even is. We're also going to be looking at some additional ratios, and these are going to be sales dollars to achieve the target after-tax income, units to sell to achieve the target after-tax income. In order to do this, I'm going to take my fixed cost and I'm going to add in my target pre-tax income, and I'm going to divide that by my contribution margin ratio, or the contribution margin per unit. Notice here that if I have to get a certain amount of income after tax or pre-tax, I'm just going to go ahead and add that to the fixed cost. It means that I have to make more money, not just to cover the fixed cost, but also to go through and to cover this after-tax profit that is desired. So when you're going through, and again, I'll say this one more time, make sure you test the ratios. If you do not test the ratios by plugging in the values to make sure that they're right, you won't like what happens next. And I've seen this happen to students on exams. It's not fun to grade. But I want to thank you for being here today. Please leave any questions you might have below, and I appreciate you liking and subscribing to the channel. I look forward to seeing you on the next video. Have a great day.